Let me ask you about what's going on around the world, Chairman, because, you know, we've seen, obviously, that we're all connected. You've just gotten back from Japan, and interest rates are negative in Japan. How worrisome is that to you?
Well, it's not worrisome in any sense. I know what's causing it, and I know it's not going to last very much longer. I mean, basically, negative interest rates occur when a hard currency like the Swiss franc or even the Deutsche Mark, or the euro aspect of the Deutsche Mark, whenever you see strong currencies in a normal market, they're spread against, say, Spain and Italy's 10-year notes is a relatively stable through time. But as the rates overall go down, clearly at some point, as the rates go down, you're going to pick up negative rates for the highest quality currencies, like, of course, the Swiss franc. And I think that this is just a passing fancy. Fundamentally, of course, we could always arbitrage against negative interest rates, but it would require a huge amount of currency in storage, and I don't think anybody is willing to do that at the rates that they are now. They might be if you got extremely high negative rates, but I don't expect that, frankly. I expect these to disappear shortly. So I'm groping for where the next outlook is. I know it isn't in our past.
Yeah. And you also mentioned the ratio between economic growth and demographics is wider than ever, particularly in Japan.
What we're looking at now is, as the Congressional Budget Office indicated earlier this week, is a significant increase in the budget deficit. And the reason that's going to occur is that we're seeing an aging of the population very rapidly, and that means essentially that an ever-increasing share of those in the population who are entitled to Medicare and Social Security rise inexorably for the next number of years.
Yeah.
And that is going to mean that you're going to get entitlements driving out or crowding out basically gross domestic savings. That's going to hit gross domestic investment of necessity. And when gross domestic investment is weakened, as we've seen for the last half-century, what happens is that productivity slows down.
Wow. Yeah, and you've talked about that a lot.
And that's where we are at the moment.
Chairman, in late June, you said the following about Britain leaving the EU. You said, and I'm quoting, "This is the worst period I recall since I've been in public service. There's nothing like it, including the crisis. Remember October 19th, 1987, when the Dow went down a record amount, 23%, that I thought was the bottom of all potential problems. This has a corrosive effect that will not go away." What do you think about that now? I mean, how do you reconcile what we're seeing in markets with these dire predictions about Britain's exit from the EU? Do you see it differently now?
Well, let me just say one thing parenthetically about that October 19th, 1987 one-day crash. You do not see that huge loss in market value of stocks reflected in the GDP. The GDP just kept going up. And that told us a great deal about how markets work. But leaving that aside, the rest of the world is in far worse shape than we. Clearly, Italy is in difficulty. They have major debt problems. The euro in general is having problems basically because, remember, the euro was constructed for the purpose of assisting in moving the European community towards a structure which was consolidated governments. In other words, it wasn't a bunch of individual governments, but a merging of all governments, so that what we had was a single eurozone or a euro.
Right. So they wanted to declare war on one another, right? I mean, they wanted a unified group.
Well, yeah, in other words, what you needed to do, they've always thought, and they still do, is a consolidation of the political aspects of the individual European countries.
Yeah, I remember you questioning it from the get-go, frankly, so I do. I remember you questioning this, saying, how do you have all of these countries, 28 countries, with different economic mentalities, just with one central bank and one currency? So is it fair to say the euro has been a failure, sir?
I would say it has been. Strangely, it wasn't for the first 8 years, and I was very surprised, having forecast that it would be a failure. And I remember vividly going before a grouping of the Bank of France and apologizing to Jean-Claude Trichet, my colleague, saying, I thought this wasn't going to happen, but I must admit, you guys pulled it off. Well, they did until it broke down. In retrospect, the reason why it worked was there was a global boom going on.
Yeah.
And during that period, anybody could sell anything. And so competitive issues with respect to currencies were irrelevant.
Yeah. Real quick, in the U.S., Dr. Greenspan, do you think businesses will start spending again soon? What are you expecting this year from the U.S. economy?
I frankly don't know. I think that we're not going to get a significant growth because we don't have the productivity, and we're not going to do what is required to get the productivity, which is essentially to slow down the rate of entitlements.
Right.
I've argued this until I'm tired of doing it, but there's no question that the entitlements have been crowding out virtually dollar for dollar gross domestic savings in the United States. The data are unequivocal on this.
Unbelievable. The
only issue is that people raise, well, how could it happen with interest rates so low? There are reasons how that can happen. It's got to do with the spread of between 5-year notes and 30-year bonds.
Dr. Greenspan, good to have you on the program this morning. Thank you.
It's been my pleasure.